Hi guys, welcome to CADS 3853, module number 14. So far in this semester, we've been talking about how it is important to be able to track the profit through the calculation of net sales, cost of goods sold, operating expenses, gross margin, and all these things. And then we led that discussion to pricing, right? The markups and markdowns and how markups and markdowns may be leading to profits. And now we are getting into a completely new topic, which is about inventory management. Okay, it's a big part of a merchandise planning and control. The inventory management discussion is going to involve multiple different small topics. First, in this module, we're going to talk about inventory valuation, and in next couple of modules, we're going to talk about how to assess the inventory efficiency, and then that will be followed by how to plan the inventory, different methods of inventory planning. So let's talk about how to value the inventory in this module. Inventory valuation basically means the assessment of the inventory level. Okay, what is the current and level of inventory that we have. Why do we need to evaluate our inventory? Why do we need to know how much inventory we have? The reason why is because inventory represents the primary investment for retailers. If the retailer deals with physical products such as apparel or any other general merchandise, that's where the most money is spent, right? And in that sense, the inventory is the largest asset. That's where their money is sitting in, right? Therefore, the retailer really needs to understand what's the level of inventory they have for them to understand how much asset they have, and so that they can manage and control it, right? If knowing how much inventory you have accurately, it really allows you to evaluate the effectiveness of your operation, whether you are you are good with the inventory level that you have. Are you going to have, do you have enough inventory to support the future sales plans, or do you have too much and you need to get rid of it? Knowing how much inventory you have allows you to make a lot of decisions for future actions, and expose problems if there are any problems, and so that you can take immediate action to correct the problems. There are two methods of assessing inventory levels. One is to use the cost value of the inventory, and the other is to use the retail value of the inventory. When we use the cost value of the inventory to assess the level of inventory, we call that the cost method of inventory. Some companies use the cost accounting, and for that matter, it is easier for them to keep track of everything at the cost value, and so that they also take the inventory at the cost value. A lot of retailers, especially apparel retailers or retailers that deal with physical products, really don't like to use the cost method of inventory because of one disadvantage, which is a really huge disadvantage. The fact that cost method of inventory doesn't allow a perpetual inventory assessment. Perpetual basically means that you have an ongoing tally of the inventory, and your inventory valuation, the inventory value, will reflect all the changes that occur to your merchandise, the actual physical inventory. Whereas the cost method of inventory doesn't allow that, because no matter how much you're changing the retail price of the merchandise, for example, you may take markdowns, and you may give some special discounts, all of those things will never be reflected in the cost value of the merchandise, because those changes are occurring to the retail value of the merchandise, right? Cost is what's paid, so what's paid is what's paid. You paid what you paid, and you're not going to be able to, it doesn't change, right? You already paid, right? So even if you give a markdown, the same cost was paid, but as compared to when you don't give a markdown. So the cost method of inventory doesn't allow you to actually track down all the operational changes that are occurring in your business. So that if you really want to know the exact value of your inventory, how much it would be given to you if you sell them, kind of way, you will actually have to take the physical count and know what is their retail price for each item, and then you just kind of add them up and things like that to be able to know the exact retail value, right? So when a shortage happens, a shortage is calculated based on how much you have in physical inventory, the retail value, and how much the book says that you should have. There is no way to identify shortages if you just keep track of your inventory only at the cost value, right? So there's that kind of non-perpetuality that really prevents a lot of the apparel retailers from using the cost method of inventory. On the other hand, the retail method of inventory, like I said before, it allows the perpetual inventory system. It allows us to take the running tally of the inventory value at their retail price, so that the retailer can understand what the inventory value is at any time. There are a lot of advantages of using this retail method of inventory. Because of the perpetuality of the inventory process, it actually makes the physical inventory process a lot more accurate. Physical inventory means you actually count physically which items are in the store and how many of them are there, and things like that, to know the exact level of the inventory in your store. When you do take the physical inventory, you always want to compare it with what the book inventory says, what the record says. If you keep track of the inventory in your record at the retail value, then the direct comparison is possible between the book inventory, the recorded inventory, and the physical inventory, which makes the physical inventory process a lot more accurate because you can actually pinpoint the differences. That differences represent what we call shortages, right? When your book says you should have a certain amount, but you physically don't have that much, that's where the shortage happens, right? So shortages can be identified through the comparison between the physical inventory and the book inventory that is assessed based on the retail value, so the retail method of inventory. Having an understanding of the retail value of our inventory at any given point of time, it really allows us to utilize that for any insurance claims that we need to make. For example, if there was a fire in our store overnight and next morning you found that half of the merchandise got burned, so you can't sell them obviously, and the other half were probably stained or smelled so much that you can't sell. So then you have to claim for the insurance to get it reimbursed. Then what would be the basis for it? If you only take the cost method of inventory, then you would only know the cost value of it, right? But if you have taken a keep track of the retail value of the inventory using the retail method of inventory, then you would actually be able to claim the insurance based on the actual retail value that you would have been able to achieve if you had sold them, right, to your customers. That would be a lot higher value than what the cost value will say. Another advantage of using the retail method of inventory is that it gives us a pretty accurate estimate of the ending inventory of each month. Right? Knowing what we started with in the beginning of the month and how much sales we make, sales are retail figure, and how much markdowns we have applied and all those things, we can estimate what our ending inventory is going to be at the end of this month, right? If we only take the cost value of the inventory, we just in the record we just keep track of the cost value, we won't be able to know what will be the ending inventory level. In spite of all these advantages of the retail method of inventory, of course, it doesn't come without any disadvantages. The biggest disadvantage is that the retail method allows the accuracy only as much as the recording system, how accurate the recording system is. So if there are any clerical errors in recording things or any systematic errors, then that's going to compromise the accuracy of the inventory valuation. And sometimes we may want to want to know the cost value of our inventory, right? But if you only keep track of the inventory value at their retail value, then when we need some cost value of it, we only can have an estimation of it. We do make an estimation based on our cumulative markup percent, but that estimated cost value may not be as accurate as the cost value of the inventory if we had kept track of all the inventory only at their cost value all the time, right? So we always be able to estimate the inventory at the cost value even if we take the retail method of inventory, but it's only an estimation. It's not going to be as precise as the real cost. Because the retail method of inventory takes into account the changes in the retail prices, that actually make it the inventory level subject to manipulation. What that actually means is that you can make it look like you actually have more or less inventory than you may have, right? For the same physical inventory you have, okay? Depending on what retail price you apply, right? For example, if you take some markdowns on certain group of merchandise, then for that merchandise the retail value reduces, right? So the the book inventory is going to reduce because of it, right? So the book says you have only that much less. Whereas the next day, if you cancel that markdown, then even if you have the same physical inventory, the same merchandise in your store, your book inventory is going to tell you that you have more than what you had yesterday. So there is that kind of manipulative aspect of it, right? So in certain cases, that could be a disadvantage. Well, I already used this term book inventory and physical inventory a lot. Let's kind of take a look at the definition of book inventory. The book inventory basically means it is a record of what you should have on hand at a time point based on all the merchandise you have received and any retail price changes, markdowns, and discounts that you have taken, and any sales of merchandise you have been able to make, the net sales of the merchandise during the given point of given time period. Then based on all this information, how much do you have to have? How much should you have? That is what the book says, that the book inventory says. Then, what are the factors that should be considered in the calculation of a book inventory? Like, there are a lot of things that happen to our merchandise that you have to take into account to have an accurate book inventory valuation. The first thing that we can think about is the opening inventory, right? For any given period, like when you started that period, how much inventory did you have at the beginning of the period? That's what we call beginning inventory or opening inventory. Okay? Since this is a retail method of inventory, we take everything at the retail value. So what was the opening inventory at the retail value? That's an important factor that is going to affect the book inventory. Okay? The higher the opening inventory, the higher the book inventory is going to be, right? If you had a lot of merchandise, your book inventory is going to go up, right? Because book inventory is nothing but what the record said, that you should have, right? So if your record said you had this high opening inventory, that means your book inventory is high too. In case you take a physical inventory, okay, that means you actually start like for example, start the month by taking the physical inventory count. So you actually physically count, which items you have and how many of them you have at what prices and things like that. Then the physical inventory is going to be more accurate record than what book says you started with, right? But what the book says your open inventory is. So whenever you take a physical inventory, that kind of becomes your opening inventory, and from then on the period starts now. So take the physical inventory kind of takes the precedence to any opening inventory the book says. Then the next factor we have to also keep track of is the purchases, right? The new merchandise we are receiving, right? Starting from the opening inventory, if you get more purchases in, some new merchandise in, then that's definitely going to be added to your inventory, right? So that is going to increase your book inventory. Then sometimes if you are operating in a multiple store kind of company, then your particular store may be getting some transfers in from another store, right? Another branch store. And when you get some merchandise in like that, it's obviously added to your inventory, so your book inventory is going to increase again. So that's an increasing factor for the book inventory. Both purchases and transfer in, of course, they are all taken in at their retail value. Now, another thing that we can think about is the changes in the retail price in terms of markdown cancellations. Okay, what would that do to the book inventory? If we cancel markdowns, that basically means that the retail price is going to go back up, right, to their original retail price. So by that much, the book inventory value has to go up, right? Because the retail method of inventory takes into account all the changes in the retail prices, right? So whenever you cancel markdown, that's going to be an increasing your book inventory. Although your physical product may be the same product, but the retail value of that product now goes up. So all the factors that we discussed on this slide, including opening inventory, purchases, transfer-ins, and markdown cancellations, they are all the factors that increase book inventory. So kind of positive factors. Well, let's continue to think about some other factors. Sales. What do you think? If you make more sales, we're selling more of our merchandise, then that is going to increase or decrease our book inventory. Whenever we sell stuff, that stuff is going to be going out of our store, so that's not our inventory anymore, right? So it will be recorded as the reduction in the inventory, right? So the book inventory will actually reduce. Okay, then what about markdowns and sales discounts? You know, sales discounts can include customer discounts or employee discounts. What about those kinds of things? Markdowns and sales discounts. Would they increase or decrease book inventories? There will be definitely the decreasing factor, right? Because when you take more markdowns or sales discounts, that will reduce the retail value of the merchandise that you have. So though you may have the same merchandise, their value is going to decrease now. So the book on the record, the inventory level will go down. How about transfer outs and returns to vendors? Transfer out basically means you are transferring the merchandise out to another store. Okay. Returns to vendor means you're returning this item back to vendors because they were not sold well, and the retailer and the vendor had an agreement that a certain percentage of the unsold items will be able to be going back to the vendor, and vendor will reimburse the cost and something like that. So if you send this merchandise out of your store, okay, either to another store or to vendor, that is going to decrease the book inventory, right? Because it's a reduction in your physical inventory, and that is recorded as a reduction in the inventory in the book as well. So it's going to decrease your book inventory. So overall, all the things that we discussed on this slide are the factors that decrease book inventory, right? Including sales, markdowns, sales discounts, transfer outs, and returns to vendor, and all these things. So when we try to have a good valuation of our inventory and try to calculate our book inventory at the retail value, we need to keep track of all the factors that we just talked about in the previous two slides. So say we have a certain amount of opening inventory at retail value, and then you add in any new purchases that you have made, again at the retail value, and any transfers in from another store that you have received, then you will have to add that in to your book inventory. That's an increasing factor, right? And then you subtract your net sales, okay? And you subtract your net markdowns. And net markdowns means, from all the gross markdowns, you subtract your markdown cancellation, right? So that will be your net markdown. And any sales discounts, if you had it, you will have to take them off of your inventory. And transfers out have to be subtracted, and returns to vendor have to be subtracted. So this kind of constitutes the formula of the book inventory calculation at the retail value. Once we know our book inventory at the retail value, and if we also know the markup percent for the total merchandise handled, including the opening inventory and the new purchases. And we should be able to plug the numbers in to estimate what the book inventory will be at the cost value, right? This is going to be the case where we know the retail value of certain things and markup percent for certain things, and we can calculate cost from those retail and markup, right? One of those important RCM relationship formulas. So book inventory at cost will be equal to book inventory at retail times 100% minus markup percent, the cumulative markup percent. Alright, so let's work on this one problem here, given all the things that we know about how to calculate book inventory at the retail value and how to estimate the cost value of the book inventory. Here is a case where a Gap store, let's say a Gap store had an opening inventory of $40,000 at the beginning of July. And during July, the store received 3 deliveries totaling $30,000 at retail. So you had an opening inventory and you have more purchases that you have received. Also, merchandise worth $550 at retail was transferred in from other Gap stores, while $390 worth of merchandise was transferred out to some other Gap stores. So there was some transfers in and transfers out. And the sales activity recorded this month included like gross sales of $52,000, customer returns of $2,000. From these two, you can calculate net sales, right? Net sales equals gross sales minus customer returns. I think you guys probably remember that. And then the markdowns were $5,000 off, and sales discounts of $350 occurred. Okay, given these operational records, okay, then what was the book inventory at retail at the end of this month? If this is all that happened in July, then what was the book inventory at the end of this month? So kind of estimating the ending book inventory, ending inventory of July. Okay, let's utilize the formula that we saw 2 slides ago to calculate book inventory at retail. Let's pause the video here while you work on the problem. Okay, so let's take a look at the answer together. Okay, the problem said there was a $40,000 opening inventory, so we start from there. And then purchases were made at the retail value of $30,000, so that has to be added in. $550 transfer in has to be also added in. There was also transfer out of $390 subtracted out. And then there was a gross sales and customer returns and allowances. You subtract customer return $2,000 from the gross sales $52,000 to calculate net sales, which was $50,000, right? Then you subtract the net sales from the book inventory. And then you had the markdowns of $5,000, again has to be subtracted out, and sales discounts of $350 has to be subtracted out to now calculate our book inventory of $14,810 at the retail value. Okay, now what does this number actually mean? If you get this number 14,810 on the book, okay, what does that mean? That means that at the end of July, okay, you should have the inventory worth of 14,810 at the retail value left in the store. That's what the book said. The book inventory is how much you should have. Alright, then the problem continues. Okay, given that the book inventory at retail was what we calculated, 14,810, I think, then what was the cost value of the book inventory? Okay, book inventory at cost, if the cumulative markup of the total merchandise handled in this store was 51%. Okay, C equals R times 100% minus markup percent. Remember that? Okay, let's calculate this. Let's pause the video. So that was not a hard calculation, right? So book inventory at retail value, which was 14,810 times 100% minus 51%, which is 49%. That gives us the estimation of the book inventory at cost of 7,256.90. So we just discussed what book inventory is, which is how much we should have according to the records. Okay. Now, in comparison to the book inventory, we also need to understand what physical inventory is. Physical inventory is the sum of the actual retail price of all items, okay, not yet sold, so they are still in our store as a result of counting the actual inventory. So you basically lay out all the the current inventory that you physical inventory that you have, and then you actually go through it. A lot of times you may use scanners to scan each price tags on these merchandise items to sum them up to know how much they are at the retail value. As I talk with a lot of large retailers like Walmart and Macy's and places like that, and I ask, how often do you take physical inventory? They actually say they take the physical inventory only maybe 2 to 4 times a year. Okay? If you think about that, all the operational things that are going on, sales and markdowns and all the things, you can imagine there could be some errors like clerical errors or recording errors that can happen um, during the period, right? And even if you do it every quarter, every 3 months, you probably will see some differences between what the book says you should have and how much you actually have when you do the actual physical counting of the inventory, physical inventory, right? And when that happens, when there's a discrepancy between your physical inventory and your book inventory, that's where we say either shortage or overage happens. So stock shortage, or sometimes it may be called shrinkage. Shrinkage or shortage, they're the same thing. In both cases, they basically mean you have more book inventory than the physical inventory, excess of book inventory over physical inventory. In other words, your book says you should have more than how much you actually have. Okay? The shortage dollar will be calculated by taking the difference between the book inventory and physical inventory. You usually do book inventory minus physical inventory. If you see any positive answer here, which means your book inventory is greater than your physical inventory, then there is a shortage. Right? If you see a negative number here, then it's going to be overage, which we will talk about on the next slide. So the shortage is sometimes we want to calculate it as a percentage number. That will be the shortage percent will be shortage dollar over net sales dollar. So shortage percent is percent of net sales, which we talked about before. You guys may remember when we talked about reductions. We first learned reductions in the context of markup calculations. When we calculate maintain markup, we talked about reductions, right? Reductions include markdowns, sales discounts, and shortages. Okay, and all those things are reductions percent is basically percent of net sales. The shortage being part of the reductions, shortage percent is naturally percent of net sales. Okay, so out of the net sales, the size of net sales that your store generates usually, how much is accounted for as a shortages? Okay, that's the question here. Why shortages occur? The easiest reason you may be able to think about it is theft, right? Employees sometimes steal stuff. Customers may come and steal things, right? Things like that happen. But theft is not the only reason why we have shortages. Okay, a lot of shortages may be due to clerical errors, reporting errors. Like when you transfer things out, you might have transferred out more expensive items, but you put the wrong price tag or something like that, so that your record says you transferred only less expensive items. Then your book will say you should have a higher retail value of the inventory, but in actuality you gave the expensive item to some other store, so you don't have it. Like things like that. Some clerical errors in recording ins and outs of the merchandise in the store. Okay? Or sometimes the shortage may occur because of the breakage or damaged merchandise, which basically means the book says you should have this value of merchandise, but when you did the actual counting of the merchandise, you realize that okay, this is supposed to be a set of top and bottom, but somehow you lost just the bottom, so you only have top, right? So the book says you have to have all, but you don't have all of them. Or that if the merchandise got damaged so much that the value of the merchandise you can no longer charge this at the regular price, so you had to actually take a markdown, which wasn't recorded originally, but you will have to do that to compensate the actual value of the merchandise and what the book says, right? So all these things, theft, clerical errors, and any damage to goods or breakage, in the merchandise, all those things may cause shortages. On the other hand, the stock overage, as I said before, it's the opposite situation, right? Where you have more physical inventory than what the book says. So excess of physical inventory over book inventory. So when you do the calculation to come up with your shortage number, so book inventory minus physical inventory, and the answer is going to be a negative number, right? Because you have more physical inventory than the book inventory. Okay? When you have a negative number here, that's when the overage happens. So, one may wonder, why would you have any overage? Why overage happens? Okay, it's always clerical errors. There will be really little cases where somebody actually brings stuff in the store, right? Just adding stuff in the store without letting that kind of case, which never really happens, right? So unlike the shortage case where you can imagine like depths and things like that, overage is always due to clerical errors. Some errors in recording things, right? When you record transfers ins and outs, somehow you made it look like you have less merchandise in the book, but you actually have more, right? More higher value merchandise is still left in the store, and then you didn't record it that way. So the recording of transfers, recording of returns to vendors, or you just put the wrong price tags, or charging the purchases to the wrong departments, things like that, that makes you have actually more inventory than what the book says you should have. Alright, so let's work on a problem, shortage and overage problem. Okay, in the previous problem that we worked on, the Gap store example, let's say the store took the physical inventory at the end of July. We calculated book inventory at retail for July for that problem, and then the book inventory was 14,810. Okay, that was what the book inventory said. Then you took the extra physical inventory and you found that the physical inventory was $14,500 worth retail value at the retail value. Then does it say that we have a shortage, the store has a shortage or an overage? Okay. And if there was a shortage or an overage, then what is the dollar for the shortage or overage? And what is the percent for the shortage or overage? Let's figure that out. Okay, let's pause the video here for a second while you're calculating this. It shouldn't take too long. Alright, first, it should be a shortage case, right? So you have less physical inventory than what the book says. Book inventory was 14,810, whereas your physical inventory is only 14,500, right? The dollar shortage amount will be the difference between the physical and book inventory, which was $310. So that much is short in your physical inventory, right? And the shortage percent will be that shortage dollar over the net sales dollar, which were given in the previous problem. So that's $50,000 net sales, right? We had a gross sales of $52,000 and customer returns of $2,000. So you subtract customer return from the gross sales. That led to the net sales of $50,000, right? So 310 divided by $50,000, that is 0.62% shortage. Alright, let's work on another problem. Okay, a lingerie department buyer was given the following data, and the data indicates the net sales, opening inventory, markdowns, returns to vendor, employee discounts, purchases, all these kind of things. For some of those items, we know the cost and retail values, like opening inventory, returns to vendor, purchases, we know cost and retail value, but the rest we are just given the retail value of them. What is the book inventory at retail? Since the question is asking the book inventory at retail value, we don't really need to refer to the cost column at all. Just look at the retail column. Okay, and let's utilize the book inventory calculation formula that we saw several slides ago to work on this problem. Let's pause the video. Okay, so the book inventory at retail will be, first, start with the opening inventory at retail, $325,000, plus purchases at retail value, $390,000, And then you had net sales, $330,000 and markdowns of $25,000. You have to also subtract net sales and markdowns, as well as the returns to vendor, $18,000. Employee discount is part of sales discount, also have to be subtracted, $6,500. So if you do this calculation, you're going to have the book inventory at retail value of $335,500. So let's continue the same problem, the same setup, and now we want to know what the book inventory at cost value is. Okay, we can estimate the cost value of the book inventory given the book inventory at retail value. And if we know the markup percent, cumulative markup percent, we will be able to do that. But the problem didn't give us the cumulative markup percent per se, right, directly, but it gave us the cost value and retail value of certain things. And we know that we can calculate markup percent based on the cost and retail, right? So we need to know the cumulative markup percent, which is the markup percent for the total merchandise handled. And so what are the total merchandise handled? Okay, we had the opening inventory, we had the purchases, right? That's usually what's used for total merchandise handled. But in this case, we also had the returns to vendor. So some part of the merchandise were back to the vendor, so we no longer have them, right? In this case, we don't have to consider the markup percent of this return to vendor because that's not our inventory anymore. So we're going to subtract that out. So the total merchandise handled will be it will be more accurate if we take the return to vendor into account, so that the total merchandise handled is now opening inventory plus purchases minus returns to vendor. Okay, so you know the cost value of each of these components and the retail value of each of these components. Okay, then you can have the cumulative cost and cumulative retail for the total merchandise handled, and from which you can calculate first the cumulative markup, right? Retail minus cost over retail will be the markup, right? Once you know the cumulative markup, then you apply that to estimate the cost value of the inventory by applying the book inventory at retail times 100% minus cumulative markup percent, that formula. Okay, let's work on this. Okay, so we first calculated the CMU percent based on the opening inventory plus purchases minus returns to vendor. At both cost and retail, we got the cumulative cost and cumulative retail, from which we eventually calculated markup percent, and the percent was, so cumulative retail was 697,000, and cumulative cost is 337,000. So the cumulative retail minus cumulative cost over cumulative retail led to the markup of 51.65% for the cumulative markup percent, and we applied that markup percent in the book inventory at cost calculation formula. So we eventually had the book inventory of 162,214.25 at the cost value. Yeah, so we're continuing on this problem. What if the physical inventory was counted as 336,000? Okay, we had calculated the book inventory at retail value to be $335,500. Okay, then we did the physical inventory and we found that a physical inventory was 336,000 worth at retail value. Then what's the shortage or overage percent? First, we want to answer whether there was a shortage or an overage. Okay, and then calculate the percentage. Again, remember overage percent is the same as shortage percent in terms of calculation. It's percent of net sales. Let's pause the video. Yeah, in this case we had an overage, right? We had a more physical inventory than the book inventory. So when you did the book inventory minus physical inventory, you actually had a negative $500, right? So an overage of $500, and overage percent would be 500 divided by 330,000, which was the net sales amount, and that gives us a 0.15% overage rate. So it wasn't too hard, right? The key takeaway from this module was that we need to keep track of our inventory level, and the way we do it is to monitor the book inventory. And every once in a while, we take the physical inventory and we compare them, and we can identify whether there was a shortage or overage and things like that. And then, with the identified shortage or overage, we have to rectify our record book inventory so that our physical inventory and book inventory will be aligned together again, and things like that. Alright, so thank you for listening, and please work on the module practice problem assignment number 14. And we're going to continue our inventory discussion in the next few modules. Bye bye.